Recession fears and skyrocketing debts have experts sounding the alarm, and frankly, all signs point to 2025 being the year the US economy finally breaks. While some experts even predict a financial meltdown worse than anything we've seen before, there are a few optimists who insist it's all fear-mongering. Which of these opinions should you believe? Well, stay with us in this video to find out. For the past few years since the global pandemic, the chances of a recession in the US have been creeping up, and there are many reasons why. For one, markets are freaking out and consumer confidence is taking a hit, especially since President Donald Trump admitted he couldn't completely rule out the possibility of a downturn. To add to that, Trump's cabinet members have hinted at a detox period ahead, reassuring everyone that their big-ticket policies like heavy tariffs, mass deportations, and cutting federal jobs and spending will be worth it, and that's even if they allow the economy to go into a financial crisis. Americans, meanwhile, are feeling sadder about the economy than they have in over a decade, which begs the question, is a recession actually on the horizon? During his campaign, Trump promised to bring in a golden age of prosperity, but just 2 months into his presidency, he's singing a slightly different tune. Now he's warning that prices won't come down overnight and that people should brace for a little disturbance before things turn around. And despite inflation that seems to be cooling down, analysts are flashing warning signs on recession risks. They're pointing fingers at Trump's policies. Some big names in finance are weighing in too. JP Morgan just bumped up the odds of a recession from 30 to 40%, warning that US policies are moving away from growth. Mark Zandi, Moody's chief economist, also turned up his forecast from 15 to 35%, blaming those large tariffs. Even Wall Street isn't happy. The S&P 500, which tracks the biggest companies in the country, took a steep dive, sinking to its lowest point since September. Another sign that investors aren't feeling too certain about what's ahead. So what's behind this uncertainty? Well, a big culprit is tariffs, Trump's new taxes on imports. Since taking office, he's imposed higher duties on goods from America's top 3 trade partners and is threatening even more. Analysts aren't too happy about this, warning that these moves could jack up prices and put the brakes on economic growth. At first, people thought Trump was using tariffs as a bargaining chip, but now it looks more like a complete restructuring of the economy, and that's what's sending markets into a frenzy. Tariffs are basically taxes on imported goods, and Trump has been using them as part of his economic strategy. The idea is that by making foreign products more expensive, businesses and consumers will be encouraged to buy American-made goods instead. In theory, this could increase domestic manufacturing and reduce the trade deficit, but in practice, tariffs can also mean higher prices for everyday items, which isn't great news for shoppers or businesses that rely on imported materials. Since taking office, Trump has slapped tariffs on products from America's biggest trade partners and made it clear that he's willing to go even further. These tariffs increase costs by making imports more expensive, forcing companies to tighten their belts. Many are already delaying hiring and investment plans because they have no clue what's coming next. Investors are also scared due to looming government job cuts and spending reductions. Meanwhile, GDP numbers also paint a picture of an economy losing momentum. Growth was strong in 2024, but by early 2025, things started to cool, with Q1 growth dropping to just 0.4%. The central bank has been keeping interest rates high to slow things down and keep inflation in check, but with all the uncertainty in the air, it's no surprise that people are getting scared about what's next. There is a little silver lining though. Inflation is actually slowing down. The latest data shows prices rose 2.8% over the past year, down from 3% in January. But despite that, Trump and his economic team are telling people to buckle up for some economic turbulence. That's quite the shift from his first term when he used stock market gains to prove his success. Now he's brushing off Wall Street's concerns, saying there will always be changes and adjustments. Investors, however, are not feeling too confident. Now, the White House does still have the chance to ease up if things start looking too bleak, but if Trump refuses to change and sticks to these policies no matter what, well then analysts say the chances of a financial crisis will keep climbing. In fact, signs of economic trouble have begun to show. Retail sales took a nosedive in February, and consumer confidence, which had surged after Trump's election, has started to wane. Big names in the business world, think major airlines, retail giants like Walmart and Target, and large manufacturers are warning that they're cutting down or preparing for a slowdown. The stock market hasn't been looking too good either, and some experts worry that a dip in stock prices could lead richer households to tighten their wallets. Since consumer spending is the lifeblood of the US economy, any significant cutback, especially from higher-income earners, could have some serious consequences. And meanwhile, lower-income households are already feeling the squeeze from inflation, making it harder for them to keep up with rising costs. But tariffs and inflation aren't the only problems. The US is carrying a massive amount of debt, and it's only getting worse. Basically, the national debt works a lot like a person stacking up charges on a credit card without paying off the full balance every month. The difference between what the government spends and what it collects in revenue is the deficit, and when those deficits keep piling up year after year, they form the national debt. Right now, that debt stands at a whopping $36.2 trillion, which breaks down to about $106,116 for every person in America. As a percentage of the overall economy, federal debt levels haven't been this high since World War II. Without major changes to tax and spending policies, the debt is expected to keep increasing with no end in sight. Now, the government's biggest expenses come from programs like Social Security and Medicare, which are becoming more costly as the population ages. And right now, the tax system simply isn't bringing in enough money to cover these growing expenses. So far, the US has managed to borrow trillions of dollars a year at fairly reasonable interest rates, but experts warn that this won't last forever. At some point, the country's rising debt could trigger a full-blown financial crisis, and the big question is when that moment will arrive. It goes without saying that even if the US avoids an immediate financial meltdown, continuing to borrow at this pace spells trouble for the long run. The government is mainly borrowing to cover current expenses, giving today's generation the benefits while passing the bill down the line. Over time, all this borrowing will push interest rates higher and eat into the money available for private investments. Less investment means slower productivity growth, which ultimately results in lower living standards for future generations. If debt keeps rising as a percentage of the economy, younger Americans will face a tougher financial reality than they would have if debt growth had been kept in check. And if a recession hits, well, the effects could be even worse. History shows that economic downturns don't just cause short-term financial pain, they can have lasting and sometimes irreversible consequences for people, businesses, and entire communities. Recessions bring job losses, shrinking incomes, and an increase in debt defaults. On a broader level, they also lead to an increase in substance abuse, mental health struggles, and social instability. Now, no two recessions look the same, but they do tend to follow a similar pattern. According to the International Monetary Fund, they typically last about a year, during which economic output, consumer spending, and trade all take a serious hit. Unemployment goes up, housing prices and stock values fall, and financial markets become chaotic. On the flip side, inflation tends to slow down due to reduced demand, but that's small comfort when so many other aspects of the economy aren't doing well. Plus, a financial crisis would be especially brutal for people just stepping into the job market, whether it's fresh-faced college grads or middle-aged workers trying to get back on their feet. And a rough economy doesn't just mean a tough time finding work, it can have ripple effects that last for decades. Take the recession of 1981 to 82, for example. People who entered the workforce during that downturn didn't just see lower wages at the start. Those financial troubles stuck with them, and the impact was even worse for non-white workers. And it wasn't just about paychecks either. These workers ended up facing all sorts of struggles down the road, from lower marriage rates and higher divorce rates to fewer children and lower-income spouses. By their mid to late 30s, the long-term toll became even clearer, with rising disability rates, worsening health, and even a noticeable drop in life expectancy. Sure, some economists argue that downturns can bring unexpected benefits, like pushing businesses to innovate or making certain markets more productive, but that doesn't erase the fact that recessions come at a steep cost. For many people, they mean many years of financial struggle, lost opportunities, and personal hardships that don't just go away when the economy bounces back. So the big question still remains: will 2025 bring America's worst financial crisis, or are we looking at another round of overblown panic? Well, the truth is, economic warning signs are flashing, but whether they lead to full-blown disaster depends on a mix of policy choices, market reactions, and global events. Tariffs, debt, inflation, and wobbly investor confidence are all ingredients in a recipe for trouble. But history shows that economies have a way of adapting, sometimes painfully, but adapting nonetheless. Even if a major crash doesn't happen, though, the long-term issues of rising debt and economic uncertainty aren't going anywhere. Future generations would likely bear the brunt of today's financial decisions, whether through higher taxes, local government spending, or a tougher job market. So will 2025 be the breaking point? Well, it's hard to say for sure, but one thing is for sure: whether it's a slow economic downturn or a sudden crisis, the financial landscape is shifting, and Americans need to be ready for whatever comes next. What do you think the future of the economy holds for the average American citizen? Let us know in the comments section and enjoy our other videos.